Hello and welcome to another video on my YouTube channel. My name is Joris and today I'm here with the fourth video of my series about investing in the world with European UCITS ETFs. And maybe this is the video where you were all waiting for, and it's about the high income ETFs. And I'm not saying high dividend ETFs, but high income ETFs. That's really important that you know that, because it's more oriented towards income. And you know the deal, I'm discussing 32 ETFs with 6 being available in multiple currencies. So that invest towards companies all over the world. The ETFs are based in Europe, so they are all UCITS ETFs. They distribute a dividend, of course, and they are not synthetically replicated. If you know of any other European-based ETF that I missed, please comment it with the ticker down below. An easing code would be nice as well. For my European series, I got some great additions for 2026, so I hope this will be the case for this series as well for when I revisit it in 2026. And now it's more important than for the past 3 videos. So it's already a long time ago, the 17th of October. So all the data that I'm presenting today is from the end of the trading day of the 17th of October of 2025. And in this fourth video, I'm discussing the 3 high income ETFs. One is actually available in multiple currencies, it's the JEPG one. And they are actually more for people that are very close to or in their retirement. I'm going to repeat this at the end of the video as well because it's really important. And also for people that like the cash flow and only to have it as a satellite in their portfolio. And I put here a smiley because, you know, I have XYLF, that's also covered call ETF, an income ETF that my wife and I have for the cash flow in US dollar, so that we can invest into our emerging market ETF EMHD that we have our eye on. We really like that ETF, and it's only available in US dollar on the Swiss stock exchange, so we needed a way to receive US dollars and faster, so we included XYLF to increase our cash flow in US dollar. So that's why we have it. We know why we have it. We know what we are buying. We know that it's seen as a synthetically ETF. JEPG isn't seen as a synthetically ETF, but it has derivatives in in its portfolio. Sorry for that. So it's selling covered calls, and yeah, it's always a strange thing. You have a lot of negative news now and a lot of negative videos on YouTube about covered call ETFs and about NAV erosion and everything. But I hope in this video I can explain a bit what's my take on it. So first off, we can go to SDIV. That's not a covered call ETF. It's a Global X SuperDividend UCITS ETF. So Global X makes the XYLF ETF that we invest towards, and that's a covered call ETF in the S&P 500. But here it goes about high yielding companies, high dividend yielding companies. So sometimes those companies are fallen angels. So they are really great companies, but they made a mistake somewhere. They dropped quite enormously in price, and that's why they are paying now out a high dividend, yielding dividend. And yeah, this ETF picks them up. And otherwise, you also have fallen angels that will keep on falling and go bankrupt. So it's possible. 3 years ago, the Fallen Angel ETF from America was really underperforming the stock market. In the past 2 years, they are overperforming the market, so it goes up and down. And SDIV in the beginning of their existence, they really had a poor performance. They went down with over 20%. Since then, they are recovering and recovering and recovering. It goes slowly, but they are going up now. And yeah, the total expense ratio is 0.45%, but as seen in the previous video, all the total expense ratios of dividend-focused ETFs are really high, and that's also the case with this one, unfortunately. You can buy one share for 7.512 Swiss francs on the SIX stock exchange, and you get US dollar as a dividend. There are 100 holdings into this ETF, and there is 420 million invested into this fully replicated type. The 1-year performance is 2.96% up, and for the past 3 years it is up 10.28%. So not that much, but at least it's positive. So a lot of people say you have a negative return, and it's true. The price went down, but with the dividend, a dividend yield of 9.87%, you make up for the loss in price, and the dividend yield is still pretty high. It was 10.80, now it is 9.80, so it is going down. If you look at the last 8 dividends, you can see the trend. So there, that's not that great at all. So that's why I don't like investing in ETFs that really focus on high yielding stocks, because you also have the fallen angels that are actually not an angel but a devil in disguise. So yeah, I try to avoid SDIV. In my first video about SDIV, I said maybe it's a dividend trap, and now it doesn't seem like it. So if you are reinvesting the dividend, you are still getting a positive return. So I have to give it to them. So I haven't that remark in my videos anymore about SDIV, because yeah, for the last 1 year and a half, it's really performing okay for such a high dividend yielding ETF. And yeah, it's for people that really know what they are buying. So check it out. Check also all the documents on the Global X site. They have all the information on their website. So check those documents out for sure. Then you have the JEPG, the JPMorgan Global Equity Premium Income UCITS ETF. If that would have been around earlier than the XYLF, I would have started investing into the JPMorgan Global Equity Premium Income ETF instead of the XYLF. That's for sure. I said it to my brother, I said it to my parents, and yeah, I'm actually a big fan of the JPMorgan ETF. So it's also on my list, just like the FGQC one, for starting investing into it. But going from 7 to 9 ETFs in our ETF portfolio is maybe a bit too much. And the total expense ratio is 0.35%, so it's actually the cheapest one of it's one of the cheapest one of the video of today. It's an Irish-based ETF, and you have a Swiss ETF on the SIX stock exchange, and you also have a US ETF available on the SIX stock exchange. So you can buy one share for 21.25 Swiss franc or for 26.63 US dollar. The dividend is being paid out in US dollar, and there are 232 holdings into this ETF. There is 1 billion invested towards this ETF, so since its inception it has gained a lot of money, and for me it's rightfully so, but there is a lot of negativity about JEPG lately, because they are not recovering that fast, just like XYLF from the tariff dips in tariffs dip in April. But in my eyes, it's still looking good for JEPG, and I will explain that in a few seconds when you look at the dividends. So it's a fully replicated type, and in the past year, it is down minus 2.69%. So yeah, just like in the previous video there, you had 3 ETFs that were in the negative, and here you have one, and it's the JEPG. So yeah, if we would have had it in our ETF portfolio together with GLDV, we would have two losers right now in our ETF portfolio. But I'm not that worried at all. In US dollar, it's still going great, great return of 6% compared to the performance of the S&P 500. It's peanuts, of course, but still it's there in the currency of US dollar. It's still positive, and it pays out 12 dividends per year, just like the SDIV one. So it has a dividend yield of 7.96%, so a little bit lower than the SDIV one. And that is because it sells covered calls on its portfolio, and it pays out the income from the covered calls that it sells to their investors. And look at the last 8 dividends. So here you can see all the numbers, and only in the past 3 months the number is slightly less than the dividend of the past year, but all the other dividends were way higher, especially the one here in July that was exceptionally high. So yeah, overall their dividend being paid out this year is way higher than the total dividend that they paid out in 2024. So in that regard, it's definitely looking great. There is a decline in NAV, but it's not NAV erosion in my eyes, because the dividends that they are able to pay out are still going up. And in that regard, I'm not very worried at all. Also, if you look at the VIX index from America, it's going all over the place, and that's a good thing for covered call ETFs as well. So I expect that their income is still going to be high enough to get a good dividend yield or income yield return, and also keep their NAV up. And when then the market picks up, there is perhaps coming a crash, you never know, and then JEPG is going to come down, but then maybe I will start buying JEPG. So that's a great possibility. And then we can go to WINC. It's a new ETF since March of 2024. It's available on the Xetra stock exchange for 4.648 euros. It's also available on the London Stock Exchange, I think, or in Italy. I'm not sure. Check that out for sure. If you type in WINC here in Switzerland, you can't find it. It's not available in Switzerland yet. It will hopefully come to Switzerland one day from iShares World Equity High Income. This one sells covered calls, and it also buys futures on its portfolio. So in that regard, it's a double cutting sword, but also a double earning sword. It has a total expense ratio of 0.35%. So that's something that is completely blowing my mind, that they are able to provide us with an actively traded fund for a total expense ratio of 0.35%, just because JPMorgan is earning a lot of money. They come also with one with the same total expense ratio as the JPMorgan one. But on the other hand, they are charging us 0.50% for the IWRD from the second video. And in the third video for the SGPX one, they are charging us 0.46%. So please, BlackRock, do something about your total expense ratio. I'm really happy that momentarily my wife and we aren't adding extra money to SGPX because our percentage needs to come down, just to yeah. I have little impact because we don't invest that much money, but at least they aren't receiving any money from us in the near future. And in that regard, I hope that other investors do the same. stop investing into those ETFs until they lower their total expense ratio. And this ETF really proves that they can lower their total expense ratio, but they are just not willing to do it. They are blinded by the greed of the 0.50% and the 0.46% that they are gaining on a huge amount of money, and they are just, yeah, putting us over. And yeah, it's annoying. So let's continue with the video. So another side note once again, sorry for that, but WINC pays out dividends in US dollar. There are 274 holdings into this ETF. There are 121 million Swiss francs invested towards this WINC ETF, fully replicated type, and in the past year it is up 3.17%. So yeah, it's still a young one, so no other data available yet. Pays out 4 dividends per year, so no monthly dividends from iShares. That's only JEPG and SDIV that are doing that, and the dividend yield is 7.65%, so that's reasonable. And the dividend payments are 0.1372, 0.1081, 0.17 and 0.1195 for the past 4 dividend payments that they made. So not bad at all, that's for sure, except the total expense ratio is up there. At least in this category, they are among the cheapest one with JEPG, but then it's really annoying that they don't lower their fees for the other categories that I'm mentioning in the previous videos. And then here is the overview already, and it's way up there because I still want to stress that it's more for people that are really close to or already in their retirement and need a cash flow, because you see that the 1 year performance isn't that great. And I know what you are saying now, hey, it's more or less the same as the 5 or 6 ETFs that you mentioned in the previous video as well. There you also had low returns, but yeah, these ETFs are really focused on income. They go for the high yielding stocks. They go for covered calls to increase the income. And in the previous video, there is really focus on quality, on investing in aristocrats that are already paying out dividends for more than 25 years, growing dividends for more than 25 years. So in that regard, it's, yeah, those ETFs are investing in companies that are way more secure than SDIV. JEPG and WINC are actually investing in reasonable companies, but of course they are using derivatives, and that's also a little bit more risky. It cuts off your upside. At least WINC has futures as well. So in that regard, I think there the upside is less blocked, and you see it a little bit in the performance as well. But I still believe in JEPG, and if it comes down with a crash, I'm definitely going to try to persuade my wife to start investing in JEPG. And with that being said, always knowing what you are investing, that's key. So it's not financial advice what I'm giving here. I'm just giving an overview. I'm letting you see what is out there in Europe for UCITS ETFs. And I hope you like this kind of overviews. And by doing that, I hope that you also subscribe to my YouTube channel to see my next videos that I put out, and hit that like button as well. That helps out my channel enormously. And thank you for watching to this one, and see you in the next one on my YouTube channel. Bye.